Okay. Well, first of all, let me thank you for the invitation. For me, it's a great honor to be here with you now online. But still, it's a very uh, good opportunity for me to interact with you and the audience to share some views on the activity and the outlook for the Chilean economy. We are in the middle of preparing our new inflation report. We will soon enter a phase that we call the silence period, where we cannot interact with with people outside the bank. That is just before our next monetary policy meeting, which is in 2 more weeks. So we're just at the beginning, almost entering this silence phase. So we can talk now, but in a week onwards, I will not be able to talk with you. So let me share some slides. My idea is to hold on. Here it is. So my idea is to talk for about 15-20 minutes. I have some slides that I want to share with you, and then I leave the space for interaction so that we can discuss and I can try to answer some of your questions. Before beginning my presentation, let me just highlight that we are this year celebrating our 100th anniversary. That's why you have there the banknote of the central bank, one of the first one from 1925, exactly 100 years ago. So as an institution, this is a very important year for us. Okay, so I will focus my presentation on the Chilean outlook. I won't talk anything about the external scenario. Of course, being an open economy, small open economy, it's very important for us what happens in the rest of the world. Most of our business cycle is driven by external factors, well, you might be very aware of what is going on, and also, as you mentioned before, the talks between China and the US are occurring right now in London. So there is still a lot of uncertainty. We don't know yet how this will evolve. So I won't talk much about that. So I will give you a brief outlook of the state of the Chilean economy up to now. I won't talk anything about projection. As I mentioned, we're in the middle of the preparation of our new inflation report that is going to be released in 2 more weeks. There we will have an update of our forecast for this year and next year. I cannot give you any hint on that yet because it's part of the process we're working on. And our previous forecast was done in March, so there have been some time already since our last forecast and the current situation. So we have to update that forecast, and that is what we are going to do in 2 more weeks. So my presentation will focus on the state of the economy right now, and then we can discuss some of the challenges we are seeing down the road. Okay, so having said that, let me begin by talking about the economy, the activity. The Chilean economy went through an adjustment phase after the pandemic. During the pandemic, there were large liquidity injections done by the government, and also driven by the possibility that people had of withdrawing money from their pension accounts. That was a substantial liquidity shock. The economy overheated. It grew almost 12% in 2022. So surpassing the level of activity we had previous to the pandemic by far. And then there was an adjustment process led by the government and the central bank in 2021, 2022, when, first of all, the central bank hiked rates substantially, and also the government reduced expenditure also in a very important fashion. And that's why in 2023 we saw a slowdown in activity. You see that on the slide on the left-hand side. And then in 2024 we began the readjustment process where we as a central bank began earlier on cutting rates, and the government began a more normal functioning in terms of the budget. The economy had a rebound, an important rebound in the second part of last year. You see that in the orange lines, bars on the left-hand side. And if you look at the sectors, well, you had commerce growing substantially. Also, manufacturers had an important level of activity, level of growth the second part of last year. And to some extent, that was driven by some transitory factors linked to the external sector. We're talking about good agro production, for example. We're talking about a wave of tourism coming into the country. So those were sort of transitory factors that helped the economy to rebound in the second part of last year. In our last inflation report, we said that those factors were transitory, as I mentioned, and therefore they should be fading away during this year. And when you look at the level of activity in the graph on the right-hand side, you see that on the margin, the level of activity in several sectors is going downwards, which reinforces the view that were transitory factors that led to this rebounding activity in the second part of last year. Last year, we were expecting the economy to grow at around 2%, and in the end, because of this rebound in the second part, the economy ended up growing at 2.6%. So an important figure above what we were expecting. So if you break down the activity on the demand side, you see that consumption in general was relatively flat last year, but in the margin, it's not that evident in the graph, but in the margin, we see some reacceleration of consumption led by non-durable goods. The blue line on the left-hand side has a speed up in the margin, and also to some extent durable goods, although the first figure for this year, there is some slowdown, but still is the case that there is an upward trend in terms of durable consumption after the adjustment we saw in 2022, 2023. So consumption is going up, not too fast, although in the margin we see some reacceleration. And that is occurring despite the fact that in terms of the labor income, we haven't seen a big impulse. Here, there are two forces counteracting in terms of the labor market. On the one hand, we see a very robust increase in wages. Those are the blue bars on the right-hand side. Real wages have been growing at a very rapid pace. On the one hand, they are recovering from the post-pandemic period where they adjusted downward, and the period where we had high inflation, where real wages went down. So they are adjusting to that period of slowdown. But also some administrative factors are playing around here, some regulation. So the increase in the minimum wage has been pushing up wages on the one hand. Also, the reduction of working hours, the legal reduction of working hours. You can see that on the graph, that the number of hours has been coming down, but also that is creating some pressure on wages, since company has to pay extra wages to keep the employment. So that is also pushing up wages. So we have seen an increase in real wages, but on the other hand, we see a slowdown in employment. Those are the orange bars on the left-hand side. We had an important increase in employment in 2022, also in 2024, but then in the last month of this year and previous year, we see there a slowdown in job creation. So we have, on the one hand, slowdown in job creation. On the other hand, we have an important rebound in wages. All in all, we have a relatively rapid increase in labor income that is supporting the expansion of consumption. But in the margin, we see a certain slowdown in terms of labor income. Now, what we see in terms of investment now, investment has been relatively flat since last year. Even before that, investment has been relatively flat. Construction is almost flat. In terms of equipment, we see some more volatility. In 2023, we saw an increase in investment in equipment, but then a slowdown. And last year, at the end of last year, we saw again a rebound. The first numbers we have for this year show again a situation where investment is not growing much. Now, if we look at the outlook for investment that is linked to this survey done by the Corporation of Capital Goods, the CBC. It's a corporation that surveys large investment projects, and they see how they are evolving over time. What we see there is that, at least for this year, there should be a lot more of investment coming mainly from the mining sector. That is the case. You can see on the right-hand side, the orange bars are large investment projects in mining. And you see that for this year, there should be an important increase in investment in mining. This survey, of course, fades away because what appears in the cadastre are the projects that are already happening. So they tend to fade away over time. So the most important thing is to focus on the outlook for this year. And for this year, there is an important rebound. So probably what we're seeing currently with investment, that this very stagnant situation for investment should change over time as this large investment project appears in the data, and they should, of course, lift investment at least during this year and probably for the next year. As always, investment in mining plays a big role. Also, investment in energy, the green bars here are the ones that are leading investment for this year. And then we see some investment in real estate. But the bulk of the investment push comes from mining and energy. Now, let me move now to inflation. We saw a rapid adjustment of inflation after the overheating of the economy in 2022, the beginning of 2023. Investment fell down to a large extent because of volatile items that fell, but also core inflation, the orange line in the left-hand side graph there, began going down. Inflation reached the target 3% in the middle of 2024, but then we saw a rebound in inflation in the second part of last year. That coincided with more dynamic activity, but also with rebound of some volatile items. Here, one particular item play an important role, which is electricity. Electricity bills were frozen during the pandemic, and then they remained frozen for a couple of more years. And last year, the government decided to unfreeze the tariff on electricity. So we had that very rapid increase in energy prices, electricity in particular, about 60% increase in tariff, which is a very important amount that had a substantial impact on the CPI. You see that on the blue line down there. And also there were some second round effect that affected core inflation. Core inflation was also affected by the depreciation of the currency and the labor pressures coming from higher wages that we saw in the previous slide. That's why the orange line there, down there, had an increase. But then, since the last part of last year and the beginning of this year, inflation in all components have been coming down. And importantly, which is very important for our decision, also inflation expectation re-anchored in the last figures. We saw some de-anchoring in certain surveys. The orange line in particular there, when we had this increase in inflation the last part of last year, there were some surveys that pointed to higher inflation in the policy horizon on a 2 year horizon, away from the 3% target. But nowadays, all surveys are pointing to 3% inflation in the 2 year horizon, which is our policy horizon. If you look at financial asset prices, they are also pointing to 3% in a 2 year horizon. So inflation expectations are well anchored again at the target of the central bank. Now, in terms of financial market, in general, we have seen a good performance. The peso has oscillated, but in general had a certain tendency to appreciate since the last part of last year. That is in line with what we have seen in other currencies. In particular, the depreciation of the dollar, of course, is playing a role here, but also the increases in copper prices have had an impact on the currency, on the CLP, and we had a certain tendency of appreciating currency, probably more muted than other currencies in LATAM or emerging market, more generally speaking, but we see a certain tendency to an appreciation of the currency. In real terms, we are slightly above historical averages for the currency. So our assessment is not particularly away from a range of values for the real exchange rate that are coherent with the long-term equilibrium value for the real exchange rate. And if you look at the stock market, Chile had a very good performance in the last month. You see the red line on the right-hand side. And if you compare the stock market with other countries in the region and the S&P, for example, the stock market in Chile had a very good performance after years of relative stagnation for the price for the stock market. So the stock market had for several years no gains, and now we're seeing a very important rebound in the stock market more rapidly than in other countries in the region. Finally, let me briefly talk about rates. What we see is long-term rates in general remain above what we had previous to the pandemic. They are running at 6%, more or less 5.5%, 6% long-term rates with volatility. If you look at the correlation of long-term rates with international rate, in particular US rates, they tend to correlate a lot in recent months. So we think that to a large extent, the level of long-term rates in Chile is very much attached to the view on long-term rates around the world, generally speaking. But in terms of the policy rate, our policy stance, the market has moved towards a view of a less contractive position, let's say. The blue line on the right-hand side there is the forward rates, what the market was expecting for the monetary policy rate based on swap rates. The market was expecting one cut this year in March, and nowadays they are expecting 2 or 3 cuts based on swap rates. And if you look at the surveys, they are also pointing to cuts already in the second part of this year, and also by the end of the year, probably more cuts for the policy rate. According to our evaluation, the neutral rate is between 3.5 and 4.5. We have highlighted that probably the neutral rate is in the upper part of this range, so probably between 4.5. So what the market is seeing right now is that the policy rate should converge to its neutral level by the beginning of next year. Of course, there have been a lot of volatility in that view because the swap rates here have tended to move to developments in the US economy, in particular, globally in the global economy, but in particular in the US economy. But nowadays, as I said, they are pointing to three cuts, which will put the monetary policy rate within the range of neutral levels by the beginning of next year. Okay, so that is more or less the situation in the economy. And with this, I'm open now to your questions and comments for us. Okay, thank you.
Well, thank you so much, Mr. Soto. That was an excellent presentation and very insightful. Thank you, and we really appreciate that. Let me begin by asking the first question. In a nutshell, how do you see the path of monetary policy going forward? Obviously, there's a lot of uncertainty, we understand, but are you doing any scenarios and scenario analysis? It'd be very good to hear your insights.
Okay, let me say two things regarding the policy rate. First of all, the policy rate is currently at 5%. The range of neutral rate is between 3.5 and 4.5. Therefore, we are above the range of values that are considered to be neutral. So eventually, we have to convert to that range once we are convinced we are on a path of inflation convergence towards the target of 3%. Inflation right now is running at 4.5% more or less, still affected by one-off from last year increases in the electricity prices. Electricity prices began increasing in July last year. They add almost 1.5 percentage point of inflation. So if you exclude electricity prices, we should be with the inflation almost at the target right now. The thing is that we know that there are one and for all impact on the price level, but for us it's important not to have second round effects from those price increases and to have a well-anchored expectation. And our analysis pointed to is that there could be some second round effect. One, we saw those price electricity coming in. We forecasted last year that there could be some second round effects. And also for a while, we saw some pressure on inflation expectations. That's why in January this year, we changed a bit the outlook for monetary policy, where we said that we should move towards the neutral rate in a careful manner in order to avoid to have inflation deviating for a persistent period away from target. What we have seen in the last month is that inflation has behaved relatively well. Inflation expectations have re-anchored, as I said, and inflation in general has behaved relatively well, with little evidence of significant second round effects. So we're now, as I said, in the middle of producing our new forecast and our new forward guidance for the monetary policy. I cannot give you any advance on that because we're just in the middle of the process. But the elements that are the foundation of this analysis are those that I mentioned. The fact that inflation has behaved relatively well, that the inflation expectations have re-anchored, and having in mind that the policy rate is still above the neutral rate. Eventually, we have to move the policy rate towards that range.
Thank you very much. I thought actually, why was so much the headline above the core? And your explanation of electricity prices was quite useful. But on the other hand, oil prices have been coming down. So isn't electricity to some extent linked to price of oil? Or are they just fixed in advance and that's it?
Yeah, well, the electricity sector is a regulated sector where you have several contracts depending on technology behind the generation. As I said, prices were frozen during the pandemic, and they remained frozen after the pandemic for a while. So we had a period of about 4 or 5 years where prices were frozen. So there was a sort of debt accumulated that had to be paid to the electricity companies, and that is part of the increase in the tariff, and also the normalization of the prices to what the level they should have had, where would not have them to be frozen back then. So that is part of the explanation. And if you look at the contracts, an energy contract, the electricity contract, of course, the energy prices, globally speaking, have an impact, but also the currency, it's important for contracts. So as long as we had a more depreciated currency, that also affects the cost of production or the contracts, let's say, and that is also having an impact here.
Thank you very much for that explanation. That was very clear. Okay, I'm going to go to the questions of the participants, even though I have a lot of questions, but let me start by saying that one of the participants had a question: do you see any damage of inflation running below 3% after many years of it being above target?
Yeah, well, no, in our forecast, in general, we see inflation convergence to the target. In the last inflation report and the previous inflation report, we saw inflation converging to the target. Our policy framework is such that inflation should converge to the target on a 2-year horizon. That's the way we look at inflation to decide on monetary policy. But based on the fact that inflation has been above the target for so many years, has meant that for us it's important to ensure that inflation converges to the target relatively quickly. So it's true that we could let inflation to run above target for a while and converge in 2-year horizon. But since the fact that we have inflation above target for so many years, has meant that for us it's very important that inflation converges in a not too long period of time to target. In our last inflation report in March, we forecasted that inflation should come back to target at the beginning of next year. So less than 2 years, less than this 2-year horizon. And that's what we said, and our monetary policy was framed under the assumption that inflation should come back to target earlier than this 2-year horizon. We are constructing our new scenario right now, but at least in the previous scenario, we were more, let's say, stringent about inflation coming back to target earlier than in previous scenarios.
Thank you very much. This is very useful. So the next question is, what is your assessment of inflation expectations? It seems surveys and break-evens are well anchored at the target now. Do you have any concerns there, or are you satisfied with how well anchored expectations are?
Well, we monitor carefully inflation expectation usually, but in particular at the beginning of this year, we saw several indicators that inflation expectation had moved away from target. Some surveys pointed that inflation expectation was above target. Financial prices also pointed that inflation on a 2-year horizon was running above 3%. And also when looking at the distribution within surveys, we saw a lot of people thinking that inflation was not going to reach target within 2 years. That occurs in January, February, and that was one of the elements we took into consideration to change our assessment on monetary policy already back in January. which was reaffirmed in our monetary policy report in March. That has changed. If you look at surveys now, they're the median and the mean of the answers is at 3%. Also, the distribution within the surveys is very well centered at 3%. And finally, financial prices also are pointed to 3% as inflation expectation on a 2-year horizon. So our assessment right now is that inflation expectations are well anchored at the target of 3%.
Thank you very much. Well, I'm going to go to a question that's in everyone's mind, and in a way, we're very interested in your view that, I mean, there are these tariffs, and of course, is affecting every single country of the world. So it would be good if you could sort of give your take on assessing the external scenario and what are the main channels that Chile could be affected by this higher uncertainty, and how are you seeing the net effects? Because as a kind of connected question to that, which struck me when I was looking at your minutes, that I was surprised to see the survey of Capital Goods Corporation showed an increase in investment plans, which is basically people deciding for the future. And they say that the outlook also for investment had rebounded, I mean, your minutes, since March, when the uncertainty had actually increased. So our understanding is that Chile is going to get 10% tariffs. So that is assuming that the appeal is not turned down in the Court of International Trade in US, although the US policymakers are saying we will have other channels to make it go through. So it'd be very interesting to hear your views on the external scenario.
Okay, so let me, well, there are several channels playing around here. So let me begin by the direct channel, which is tariffs, based on the assumption that 10% tariff will apply to our export to the US. They affect, generally speaking, agricultural goods. Timber has been excluded from tariff, which is an important export to the US from Chile. So that part of the export will not be affected. And then we have copper that again has not been affected by tariff up to now, this 10%. So tariff will affect part of our export to the US, not all of them. In general, are goods that tend to have a relatively inelastic demand. So probably it won't affect much the quantity produced. There might be some impact, but being goods based on natural resources like agricultural goods and stuff like that, we don't think there will be the demand, elasticity demand is relatively inelastic, so there should be such a large impact on production. So that's the direct effect of tariff. Then, of course, there is all the impact related to the uncertainty that has created the trade policy and all the go-ons and off that we have seen in recent weeks. But in terms of investment, again, which could be the impact on Chile, when you look at the matrix of investment, is heavy on energy and mining, and those are more long-term investments, and where the short-term uncertainty we're seeing right now probably is not that important. Demand for copper, there will be always, the copper price has gone up, actually, not go down. There's some speculation about tariff on copper. That's why probably the copper price has gone up, but still is the case that the copper price is running at or above long-term values for the copper price, and that creates incentive for investment in that sector. Then we have the impact on the global economy. There could be an impact on the global economy that could have an impact on the demand for our exports, more generally speaking, not only the exports that are affected by tariff, but more generally speaking, demand for export coming from a slowdown in the global economy. We have put numbers to that already in the previous inflation report. We had a revision downwards for the global economy, and we incorporated that effect on our outlook. There is an impact, of course, but it's not that large in terms of activity. And then we have the positive impact for an economy like ours. There could be some deviation of trade where we can benefit from lower prices, for example. Although in the short run, probably that is not the case, but eventually we could benefit from lower global prices if there is a trade deviation. And also, Chile overall appears to be relatively stable as an economy. Part of the uncertainty of our economy that we saw a couple of years ago has been reduced. I think the confidence or the importance of growth has been put back in the policy debate in Chile. For several years, we were not discussing about growth in this country, but now we're talking about growth again. We have an election coming in a few months, and most of the candidates from all the political spectrum are pointing to the need for growth, to the need for facilitating investment. Actually, this government has a bill in Congress to facilitate investment. So this consensus on the importance of growth has come back to the political discussion, and to some extent that is counteracting the increasing uncertainty we see overall in the world. Then when you look at the domestic discussion, there is less uncertainty in terms of the importance of growth, and I think that is a positive element. That is reflected when you look at the stock market that I showed to you, that the stock market in Chile has had a very good performance. Probably that is reflecting that renewed view that the growth is important.
Thank you very much. That's very interesting, and also the prospect of election is very relevant. So let me ask you again, going back to monetary policy, what would be the costs and benefits of resuming rate cuts as soon as June? And in a way, is June at all a possibility? And that's what they keep asking. And also relevant, which I'll combine these questions, is your movement of policy rate in relation to the US Fed's policies. So also relevant is the situation of the dollar. If the dollar remains weak, could we have a negative interest rate differentials between these two countries? So to summarize, what are the costs and benefits of June? Is June at all a possibility? And also movements of your rates vis-a-vis US Fed. Over to you.
Yeah, well, first of all, I cannot advance any policy decision, of course, not my own decision, not what the board will decide on June. there are, well, the options to be discussed in June are not yet there. The only thing I can tell you about monetary policy, more generally speaking, is that if we're sure that inflation is in a solid path towards target, then eventually we have to bring our policy rate to a level that is coherent with the neutral rate, okay? And we're in the process of evaluating whether we are in that path of consolidating inflation back to the target. So speaking now between the relationship between our policy rate and the US policy rate, well, we have emphasized that we have a flexible exchange rate that should adjust to any fundamental variable, including the interest rate differential. So we are not attached to the US policy rate, to our own decisions on policy rate. So we take that as an input for our decisions. Of course, if we move our rate and that affects the interest rate differential with the US, there could be some impact on the currency. But that needs to be evaluated against the backdrop of the convergence of inflation to target within that 2 years horizon, okay? So eventually, if we have a, let's say, depreciation of the currency that has an impact on short-term inflation, but does not affect the convergence of inflation towards target, well, that shouldn't affect our policy decision. Whereas if we think that changes in the exchange rate could risk having an impact on the convergence of inflation to targets, then that will be an important element to be taken into consideration for our decision. But more generally speaking, we have a free floating currency. We are a free floater, so the currency has moved around up and down. And I think for our economy, that has helped a lot, containing shocks. Shocks coming from the external scenario are accommodated by the movement of the currency. And since we're living with a volatile exchange rate for many years already, the economy has managed to adjust to that volatility, and companies in general are well prepared to live with the volatility for the currency.
Thank you very much. That's very interesting. I don't believe in R star at all, but somebody's put a question. The question reads like this: is there a consideration that R star needs to be higher than in the past, given recent data points? GDP is running a bit higher than expected before. IMAC number was running stronger than expected, and inflation is contained, but not falling off a cliff. It seems that trade war tension is dwindling, and in general, Chile is not expected to be heavily affected by it. What, in your opinion, is the possible scenario that will justify a move lower in rates? Well, in some ways, you've answered it. Maybe you can just say a couple of words about that.
Yeah, well, when we say that we have a range of estimates for the neutral rate or R star, those models are based on different considerations. For example, we have some models that are based on the link between potential growth and the neutral rate. And in general, we've been revising downwards our potential growth for Chile. It was above 2%, and now it's more close to 2%, even below 2%. So those downward adjustment of potential growth are attached to a downward revision for the neutral rate. But on the other hand, we have other models that link our neutral rate to global neutral rates, or the view of the neutral rate for the US economy or other economies. based on the non-arbitrage condition of rates. And in those models, we have tended to revise them upward for the value of the neutral rate. That's why we have this ample range between 3.5 and 4.5. If we are within that range, well, we have to evaluate whether we feel comfortable or not with the policy rate. But by now, we are away from that target, not too much away, 50 basis points from the upper bound. But still, we are above that. So that's why we think that eventually the policy rate should go down as long as we are convinced that inflation is in the right path to the target of 3%.
Thank you. In the last meeting, meeting statement, BCCH said that price pressures would decline in countries that do not modify their trade policy. Should we understand that Chile is included in this group since it's not changing its policy?
So can you repeat the first part of the question?
Sure. In the last meeting statement, BCCH said that price pressures would decline in countries that do not modify their trade policy. Should we understand that Chile is included in that group since it's not changing its policy?
Well, I think what we said in the minute that we could have, as I said, benefit in a way from a trade deviation. If goods are not flowing into the US because of tariff, they eventually will flow to other countries, including Chile, and that could create downward pressures on prices. That's what we have in mind. Of course, in the first month of this year, what we saw was a stock piling of stocks in the US in advance of tariff. So probably there is still no such a room for such a trade deviation. But eventually, once tariff began hitting, there could be some trade deviation, and that could benefit us in terms of lowering price pressures.
Thank you very much. I was just looking at the unemployment rate, which again in your statement said that it was, currently standing at 8.3%, and there is limited slack in the economy. And then looking at the highs and the lows, Chilean unemployment has gone down to as low as around 5%. So, which means that the economy can tolerate around 5% unemployment. Wouldn't you say that at around 8 or over 8%, there has to be some slack?
Mm-hmm. Yeah. So yeah, two comments about that. First of all, the economy had a lower unemployment rate when it was growing much more than now. So when productivity in particular was growing much faster. That is the period where we saw lower unemployment. And what we see now is that trend growth or potential growth has come down because of slowdown in productivity. That is coherent with the view that probably the equilibrium unemployment is higher than what we had before. So that's one thing. The other thing is that view in terms of the slackness of the economy coming from the labor market takes into account the fact that there have been some wage pressure coming not from the tightness in terms of labor or employment, but rather than because of regulation, the increase in the minimum wage, the reduction in the legal number of hours you can work, and other regulations that have been applying to the labor market, and that created some pressures on wages. So given that, we say that probably the unemployment rate, which is coherent with a slackness in the economy, is higher than what we had before. Now, once those regulations fade away, for example, the minimum wage that is decided on a yearly basis, regularly speaking, once that fades away, then probably we have to reevaluate what is the equilibrium unemployment rate that is coherent with no inflationary pressures.
Thank you very much. That's very helpful. Next question is, are you comfortable with market pricing at the moment?
Market prices, in which market?
Market prices in your policies.
For monetary policy.
Yes.
Well, what the market is pricing right now is somehow similar to the center of the corridor of our last inflation report. We have to produce a new corridor for the next inflation report. As I said, we're in the middle of that process right now. So the only thing I can say is that market have aligned to what is the center of our corridor. For a while, market rates were above the corridor. So there was a discrepancy between the market's view and our own view in terms of monetary policy. And I think market rates have tended to align with was at least our view in March. We have to see what happens now. But at least in terms of what was our view in March, I would say that market rates have tended to align to that view.
Thank you so much. That's really great. Next question is, break-even never really returned to 3% across the board. Is that a concern for you?
Well, according to our own data, they are actually at 3%. So at least on the one-on-one break-even, which is the focus for us, which is the 2 years horizon, the horizon for our target inflation, it is at 3%. So I don't know what data are you seeing, but at least in our data, we see that one-on-one break-even at 3% right now.
Thank you very much. That's good to know. Another question is on service inflation, which reached 7.27% in May, and core services stuck at 4.2%. Is that a concern for you?
Well, we have discussed in our inflation reports in the past this fact that we see it here and also in other countries that services inflation has remained higher and has been more persistent than what we were expecting. So this is a fact. This is a fact for Chile and for other countries where we have a very rapid convergence of goods inflation, but services inflation remain relatively high and persistently high above target. Having said that, in our case in particular, services inflation is affected by this electricity component, for example. That is a regulation matter. There is no fundamental economic reason behind that. It's just a regulation matter that is affecting and will affect inflation for a while. But it's true that we have seen other components of services running above the target. That is linked to some extent with the increases in wages. Again, regulation, the increase in the minimum wage, for example, had an impact on services inflation. That should fade away over time, but will create some pressures on services inflation. And more generally speaking, if you look at the broad picture and long-term trends, it's true that in general we see services inflation a bit above goods inflation. There is a change in relative prices occurring over time, and probably that will have an impact on the differential between services inflation and goods inflation. To be on the target of 3% would be normal. To have higher services inflation and lower goods inflation, that shouldn't be something surprise us, as long as the average is at the 3%.
Thank you very much. Another question is, in your view, would you regard the strong activity prints have been driven by one and be regarded as one-offs, so that it's not something that should be regarded as normal, and just as one-offs? And has the CPI changed the assessment that core inflation has been surprising on this downside? But obviously, it's more on the question of whether you regard this strong activity as a one-off.
Yeah, we have seen some components of activity that are linked to the external scenario, but tend to be one-offs. For example, agricultural production. We have a very good season last year that had an impact on agricultural production, on export, and also on commerce, because to a large extent, a lot of the activity that creates the agricultural sector is translated into commerce. So we saw that. And also part of the agricultural products are manufactured later on. We had a good fish capture, for example, good agricultural season, and that had an impact on activity, surprised us on the upside, but are transitory factors by nature. That's one thing. And the other thing is the tourism. We had a very exceptional tourism season that is linked to a large extent what is happening in Argentina. We had a real depreciation of our currency vis-a-vis the Argentine peso. So we became competitive in terms of tourism. In Argentina, they liberalized also the use of foreign currency that allowed them to travel more, and we receive a lot of tourism from Argentina. And that had an impact on activity, a visible impact on activity. But again, that is probably a one-off because it's a seasonal matter. We have to see next year. But yeah, are tend to be one-off. That's why we say that probably activity will slow down a bit in the second quarter of this year, and we have to see what happens in the third and fourth quarter.
Well, thank you very much. We've come to the end of our time. Of course, we are aware that there were lots of questions that I couldn't cover in this time period. It was really wonderful to hear you, and thank you so much for your very clear answers and explanations. We are very grateful to you, and to those who didn't get their questions answered, we very much hope what Mr. Soto has already answered has been helpful, because he covered a large area. It's been really wonderful to have you. Thank you again, and we hope to invite you again as and when your time permits. And thank you to the participants and those our colleagues who organized this seminar. Thank you. And
thank you, and thank you to the audience. See you soon.
Goodbye. Thank you. Bye-bye.
Bye.